Hi everyone, Nick here. Does it make more sense to invest in the S&P 500 or the Nasdaq 100? Well, you could buy some of each. It's good to compare the two so you know what you're buying. We're going to discuss the differences in these indexes. Then we'll look at some ETFs or mutual funds you can use to invest in the indexes. For comparisons in this video, I'm going to use the Vanguard ETF VOO for the S&P 500 and Invesco's QQQ ETF for the Nasdaq 100. These indexes are conveniently named in a way that indicates roughly the number of companies that make up the index. 500 companies for the S&P 500 and 100 companies for the Nasdaq 100. Don't you wish everything was named this way? It's pretty clever, and I've decided to adopt this naming scheme for my video. Welcome to the Index Comparison 1000. 1000 is the approximate number of like buttons that need to be smashed to support free financial education on YouTube. So what are you waiting for? Smash away. Let's start by looking at the management and strategy of these indexes. Overall, the management structure of these indexes are very similar. Both indexes track the performance of a group of large companies in the US stock market. Both are market capitalization weighted indexes, meaning the companies that are worth more money will have a higher weight in the index. Both are managed by a company that applies strict criteria when selecting which companies get added and removed from the index. Both periodically adjust the composition of the index and rebalance. The main difference in these benchmarks comes down to the type of companies or sectors they are including in the indexes. The Nasdaq focuses on US companies at the forefront of innovation, such as Apple, Microsoft, Alphabet, Amazon, and Tesla. These are mostly large companies that are expected to have high future growth. The S&P 500 focuses on being representative of 500 of the leading companies in the US, regardless of expectations for future innovation and growth. It covers roughly 80% of the entire US stock market. Let's look at how this translates to exposure to the different sectors. The Nasdaq 100 is heavily weighted towards technology, consumer services, and healthcare, with roughly 86% of the index allocated to these three sectors, and roughly 57% of the index in the technology sector alone. The Nasdaq 100 entirely ignores certain sectors, such as financials, basic materials, oil and gas. Telecommunications and utilities are almost non-existent. The S&P 500 is indiscriminate of the innovation factor and just allocates to sectors more in line with the market capitalization. While financials and industrials may not be sexy, they are a big part of our economy and are reflected proportionately in the S&P 500 index. It also has its largest exposure to technology, representing 23% of the index. The tilt towards innovation has resulted in the Nasdaq having higher exposure to growth companies. Let's look at the equity styles of these indexes. We can see that both hold nearly all large companies. The big difference is the Nasdaq 100 is weighted towards growth companies. We all invest to make money. Ideally, every dollar you invest, you get a good amount of profit. Value companies generally provide more profit per dollar you invest in the near term. However, growth companies are expected to generate higher profits in the future. Think of a company like Verizon versus Tesla. Verizon makes a consistent, steady profit, and it's growing at a very slow pace. Whereas Tesla is just starting to make money, but is expected to grow at 50% each year. Investors pay more for Tesla now, with the expectation of future growth that is higher. With the focus on innovation in the NASDAQ 100, it is skewed more towards growth companies. How has the strategy of overweighting technology and innovation worked? Since 2011, the NASDAQ 100 has crushed it. It has delivered a compounded annual return of 20%, while the S&P 500 returned 13.8%. If you invested $10,000 in both indexes at the beginning of 2011, the value today would be roughly $64,000 for the NASDAQ 100 and $37,000 for the S&P 500. This is a huge difference with the compounded returns over 10 years. 10 years in investing is not a very long time. There are cycles in markets that cause some sectors to do better than others. Let's go back to the year 2000. This period does reflect the bursting of the dot-com bubble, which may be slightly unfair. It shows the performance is comparable between the indexes, with a compounded annual return of 6.56% for the S&P 500 and 6.71% for the NASDAQ 100. One thing to note here is that during the pop of the dot-com bubble, the NASDAQ 100 experienced a drop of nearly 81%, while the max drawdown of the S&P 500 was 51%. We can see that annual returns show that the NASDAQ 100 has generally done better in years where it's performed well, but worse in years where it's performed poorly. The volatility has generally been higher, probably because it's less diversified. If you go back to the early 1970s, the NASDAQ 100 has returned a compound annual return of roughly 9.5%, while the S&P 500 a little over 7%. So does it make more sense to invest in the NASDAQ 100 or the S&P 500? Well, this isn't investment advice, it's just my opinion. There are two big money questions. First, will this outperformance happen in the future? Just because these innovative tech companies have done well in the past doesn't mean they will do so in the future. What happens if people are collectively overestimating the prospects and the price is just too high? Let's say the price of a company reflects expectations of 50% year-over-year growth. What if it only achieves 25% year-over-year growth? It would still be a hugely successful company, but it would be a poor investment. This is a bit of the risk you take when concentrating investments in innovation and growth. The second question is, can you stomach the potential increase in risk? It is really easy to say you can tolerate risk after a winning streak. But would you have held and continued to buy the NASDAQ 100 in 2001, 2002, and 2003 when it suffered 40% declines each year? You would have seen your investments pummeled, and buying the dip would have just resulted in even greater losses for 3 consecutive years. Be honest with yourself. Would you have had the conviction to continue to hold and buy? Many people have experienced investing in a short decline, like that of the brief crash last year. It's much easier to hold your conviction when the decline only lasts a couple months. After 3 years of 40% losses, I bet many people would have lost their conviction. When it comes to risk, it's generally better to underestimate your risk tolerance than to overestimate your risk tolerance. Overestimating your risk tolerance leads to buying and selling at the wrong times. If you are comfortable with the extra risk and feel strongly about the tech industry and innovation, I think it's reasonable to buy some of each index in proportion with your risk tolerance. And that risk tolerance will vary for everyone. I do not invest in the Nasdaq 100. I invest in the S&P 500 index and the total stock market index. I made another video comparing the S&P 500 and total stock market indexes, which I'll link up here and down below. I believe that markets are mostly efficient. Instead of trying to forecast which sectors or companies will outperform, I let the collective wisdom of the market decide. There are millions of people that know more than me about the prospects of given industries or companies. If the prices of the industry or company are wrong, they will make bets accordingly, and the price will eventually correct and reflect their better knowledge. Most professional investors fail to beat the market over long periods of time. Instead of trying to beat the professionals in my spare time on nights and weekends after work, I think my time is better spent increasing my income. I made another video where I shared 6 tips on how to double your income, which I'll link up here and below. In addition, I'm a software engineer and I work for Google. My income is directly tied to the success of technology, and I receive some of my compensation in the form of Google stock. This is enough extra exposure for me, and I see no reason to get greedy. Now let's look at different options for investing in these indexes. There aren't many options for investing in the Nasdaq 100. There are a couple ETFs I'm aware of. QQQ is one of the most popular, and QQM is very similar and has a slightly lower expense ratio. And it's said to be geared more towards buy and hold investors that are focused on cost savings. The S&P 500 is one of the most popular indexes, and there are far more options. I like Vanguard and Fidelity the most. Vanguard offers VOO as an ETF and VFIAX as a mutual fund. Fidelity also has a great mutual fund, FXAIX. If you prefer Schwab, they have SWPPX. Thanks for watching, everyone. Do you plan to invest in either or both of these indexes? Let me know what you think in the comments down below. Make sure to smash the like button if you got value, and don't forget to subscribe so you don't miss out on future content. Later.